Welcome back to Money Talks, your guide to the Canadian Securities course. I'm your host, Rita. Thank you so much for your continued support. It truly means the world to us and helps us bring you valuable content for your financial education and career here in Canada. If you're new here, don't forget to subscribe, like, and leave a comment. And if you find this episode helpful, please share it with your friends. For those of you preparing for the CSC exam, we've got you covered. You can download a free, concise study guide on our website. And if you're serious about acing that exam, check out our complete study guide, packed with mock tests covering both Volume 1 and 2. Just visit mtalks.ca. That's mtalks.ca. Today, we're diving into a topic that affects every single investor: Canadian taxation. And to guide us through this complex world, I'm thrilled to welcome a special guest to the show for the first time. Rachel Underwood is a seasoned tax professional who has worked with a wide range of retail and institutional clients in the financial field. Hey, Rachel, welcome to the show.
Hi, Rita. Thanks for having me. It's great to be here.
How's everything going in the market? It feels like there's never a dull moment.
That's the truth. It's always dynamic, which is why understanding the fundamentals, especially tax, is so crucial for investors to protect their returns.
Absolutely. Let's jump right into it. When we invest, we can earn money in different ways: interest, dividends, capital gains. A dollar is a dollar, right? Or does the Canada Revenue Agency see it differently? That's the perfect place to start, Rita. The CRA definitely does not see all investment income as equal. In fact, how your earnings are taxed depends entirely on their source, and the difference is significant. Think of it like 3 different flavors of income, each with its own tax recipe. First, you have interest income. This is what you earn from GICs, savings accounts, or bonds. The government treats this income just like your salary. Every single dollar you earn in interest is added to your income and taxed at your marginal tax rate. It's the most heavily taxed type of investment income. So if my marginal tax rate is, say, 30%, I lose 30 cents of every dollar of interest I earn to tax? Exactly. It's straightforward, but also the least tax-efficient way to earn investment income. Now, the second flavor is dividends from taxable Canadian corporations. To prevent heavy double taxation, the government uses a system called the gross-up and dividend tax credit. The result is that dividends from eligible Canadian companies are taxed at a much lower rate than interest income. That makes them much more attractive from a tax perspective. Absolutely. And that brings us to our third and most tax-friendly flavor: capital gains. A capital gain is the profit you make when you sell an investment, like a stock or a mutual fund, for more than you paid for it. Here's the magic number to remember: 50%. In Canada, only 50% of your capital gain is taxable. Okay, we've covered how income is taxed in a regular investment account, but this is where it gets really interesting. Many Canadians use special accounts like RRSPs and TFSAs. How did these accounts change the tax equation? They change it completely. These registered accounts are the government's way of encouraging us to save for important goals. They do this by offering powerful tax advantages. There are 2 main types: tax-deferred and tax-free. Your RRSP, or Registered Retirement Savings Plan, is the classic example of a tax deferral plan. Think of it as a pay-the-tax-later plan. So the RRSP sounds great, but how do I know my limit? Is it the same for everyone?
Great question. It's personalized for every Canadian. The calculation starts with a simple rule. Your contribution limit is the lesser of 2 amounts: 18% of your previous year's earned income, or the maximum annual dollar limit set by the government, which for 2024 is $31,560. What counts as earned income? It's mostly your employment income, but it also includes things like net rental income or net income from self-employment. Things like regular employment insurance benefits don't count, though. The CRA looks at your income from the previous year to determine your room for the current year.
Okay, so it's 18% of my income up to a maximum. That sounds simple enough. It starts there, but there are 2 very important adjustments. First, if you have a pension plan at work, the value of that benefit, called a pension adjustment, or PA, is subtracted from your RRSP room. Your employer reports this on your T4 slip. The government does this to ensure everyone gets a similar level of tax-assisted retirement savings, whether through a pension or an RRSP. That carry-forward rule is a lifesaver.
What happens if I get a little too enthusiastic and contribute more than my limit? The CRA gives you a small buffer of $2,000 over your lifetime, but if you go beyond that, there's a penalty tax of 1% per month on the excess amount. So it's really important to check your limit on your notice of assessment or your CRA My Account online.
This is such a clear breakdown, Rachel. I want to pause here for a moment and speak directly to our listeners. If you're finding this information valuable, please take a second to hit that subscribe button and share this episode. It helps us grow and continue creating content like this. And remember, you can listen on Spotify, Apple Podcasts, YouTube, Audible, and Podbean. For those essential study guides to ace your CSC exam, head over to mtalks.ca. We're back with tax professional Rachel Underwood, diving deep into RRSPs. Rachel, we've covered the contribution limits. What if I don't have cash on hand, but I own stocks in a non-registered account that I'd like to move into my RRSP?
That's called a contribution in kind, and it's a powerful tool, but you have to be very careful with the tax rules. The moment those shares enter your RRSP, the CRA treats it as if you sold them. This is called a deemed disposition. So even though I didn't actually sell them, I have to calculate a capital gain or loss? Exactly. If the shares have gone up in value, you have to report that capital gain on your tax return for that year and pay tax on it. Here's the tricky part. If the shares have gone down in value, that capital loss is deemed to be nil. You can't use it to offset other gains.
Wow, so you get taxed on the gain, but you can't claim the loss. That's a trap.
It is. So the strategy here is if you want to contribute an investment that's at a loss, you should sell it first in your non-registered account to realize the capital loss, and then contribute the cash to your RRSP.
That's a great tip. Now, what about taking money out? Let's say I need to access my RRSP funds before retirement.
You can withdraw from an RRSP at any time, but it comes at a cost. First, the financial institution is required to charge a withholding tax right off the top and send it to the government. For most of Canada, that's 10% on withdrawals up to $5,000, 20% on amounts between $5,000 and $15,000, and 30% on anything over $15,000.
Is that all the tax I pay?
No, and this is what trips people up. The withholding tax is just a prepayment. The full amount you withdraw is added to your income for the year, and you'll have to pay tax on it at your marginal tax rate. If the withholding tax wasn't enough to cover what you owe, you'll have a bill come tax time.
The RRSP is clearly a cornerstone of retirement planning, but what other registered accounts should Canadians know about?
An incredibly effective strategy for couples is the spousal RRSP. The higher income spouse can contribute to an RRSP in the lower income spouse's name, but the contributor gets the tax deduction based on their own income. The idea is to build up retirement savings for both spouses so that in retirement you can split the income and pay less tax overall as a household.
That's a smart way to income split. Are there any rules to watch out for?
There's a very important one called the attribution rule. If a contribution is made to a spousal RRSP and then withdrawn within the same year or the following 2 calendar years, the withdrawal is taxed in the hands of the contributor, the higher income spouse, defeating the whole purpose. So you need to wait at least 3 years from the contribution before making a withdrawal to ensure it's taxed in the lower income spouse's hands.
Good to know. Let's shift from retirement to another major expense, education. How can families save for that? For that, we have the RESP, or Registered Education Savings Plan. Contributions aren't tax deductible, but the money grows tax-free. The best part is the free money from the government. Through the Canada Education Savings Grant, or CESG, the government matches 20% of your contributions, up to $500 per child per year. So if I put in $2,500 for my child, the government just gives me an extra $500?
Exactly. It's an automatic 20% return on your investment. There's a lifetime grant limit of $7,200 per child, which is a massive boost for education savings.
That's amazing. And finally, there's a newer account that's been getting a lot of attention for home buyers.
Yes, the First Home Savings Account. It's a fantastic hybrid that combines the best features of an RRSP and a TFSA for first-time homebuyers. Like an RRSP, your contributions are tax deductible. And like a TFSA, when you withdraw the money to buy your first qualifying home, the withdrawal, including all the investment growth, is completely tax-free. You can contribute up to $8,000 per year with a lifetime maximum of $40,000. It's truly the best of both worlds for aspiring homeowners.
Rachel, this has been an absolutely fantastic masterclass in Canadian investment taxation. You've taken a very complex topic and made it so much easier to understand. Thank you so much for joining us.
My pleasure, Rita. Happy to be here.
So, to recap for our listeners, understand how different investment incomes are taxed, maximize your powerful registered accounts like the RRSP, TFSA, RESP, and FHSA, and use smart strategies like spousal contributions to optimize your returns. That's all the time we have for today on Money Talks. A big thank you to our guest, Rachel Underwood, and to all of you for tuning in. Don't forget to subscribe, share this episode, and visit mtalks.ca for your CSC study guides. We'll see you next time.